Welcome once again to When the Facts Change, economics and politics in a fast-moving world, with me, Liam Halligan. Now, I'm a huge believer in Britain's small and medium-sized enterprises, which employ 2/3 of our workforce and are hotbeds of innovation and enterprise. SMEs are the UK's growth engine, and they used to rely on high street banks for the finance they needed to really develop. Back in 2008, prior to the global financial crisis, bank lending to SMEs was around 2.5% of UK GDP. But since then, Basel III regulations and a retrenchment of branch networks has seen bank lending to SMEs collapse to just 0.5% of national income. Traditionally, the UK's SMEs have also been able to access finance via the City of London, which attracts capital from around the world, looking for good investments, not least in Britain. Over 30 years ago, the London Stock Exchange launched AIM, the alternative investment market, specifically to help finance small and medium-sized firms. Since 1995, AIM's helped UK SMEs raise tens of billions of pounds, generating countless jobs and driving the economy forward. Seasoned finance professional James Sheehan is a strong advocate of AIM. A director of capital markets at Bowsprit Partners, he's been heavily involved in plenty of listings on the junior tier of the London Stock Exchange and is a champion of the UK's SME sector.
It's huge, right? It's effectively the lifeblood of the engine room that is the UK economy.
Over recent years, James has helped to list, among other SMEs, Energy Pathways plc on AIM, focused on low-carbon energy solutions, the Priority Intelligence Group, providing cost-effective AI for small firms. He oversaw the listing of Volt's Capital on AIM, an investment vehicle maintaining a Bitcoin treasury reserve. And earlier this summer, James and his team completed the AIM listing of Talon Resources, a precious metals exploration company. But AIM, so to speak, is increasingly missing the target. There have been historic wins with major firms like holiday company Jet2 and radio frequency group Filtronics starting out on the junior tier. But over recent years, as bank finance for SMEs has diminished, the number of AIM-listed firms has also collapsed. Back in 2007, almost 1,700 companies were listed on AIM. As regulation and listing costs have increased, though, with tax advantages being curtailed, that number's plummeted to little more than 600 AIM-listed firms today. AIM as a whole has tended to generate lower returns than major London stock indices, the FTSE 100 or 250. The junior tiers has created major players that have graduated to larger exchanges, like Domino's Pizza, Peppa Pig owner Entertainment One, and hotels group PPHE. But with the new listings down so sharply, the overall size of the AIM market is now at a record low. James Sheehan is concerned, as am I, that the City of London and our broader financial services sector is failing in a more general sense, with just a tiny share of our pension assets and other domestic savings now being channeled into domestic firms, not least UK-based SMEs that will generate tax revenues, wealth and prosperity for Britain in the years and decades to come.
For the next generation, right, we're not putting that supportive capital to work. Our pension money, right, our savings as a nation do not go into funding our children's and our grandchildren's jobs and the opportunity that those are going to provide.
James Sheehan also worries, as do I and countless finance professionals across Britain, that massive government borrowing is now sucking away capital from productive companies. And with a staggering 80% of that borrowing now being spent on debt interest, the UK is in danger of a fiscal collapse.
If a business came to me with that balance sheet and said, "Can you float me?" I'd be saying, "No, you're insolvent." So ultimately, that's where we are.
Since 2023, after the COVID plunge and bounce back, the UK economy's expanded just 0.8% a year. Sluggish growth drives up benefit spending and undermines revenues, weakening our public finances even more. It's vital that Britain kickstarts growth, not just to tackle our cost of living crisis and rising unemployment, but also to stabilise our national accounts. This latest edition of When the Facts Change, an extended conversation with a genuine financial insider, explores how revamping AIM, the junior tier of the London Stock Exchange, could help make that vital growth happen. James Sheehan, great to have you with us here on When the Facts Change. As an entrepreneur, as an investor, as somebody who raises money for British companies, particularly in the tech space, how do you think the business environment is in the UK at the moment?
I think we've had a really long period of decline in certainly the entrepreneurial spirit in the UK. Don't get me wrong, we've had a phenomenal leadership across Europe when it comes to the emergence of tech unicorns over that period of time, but I do feel we see a lot of that entrepreneurial spirit have to migrate abroad to really get the big impact it wants to have in terms of finding finance and funding when it comes to the real crux of actually growing those companies.
Is the talent there? Is Britain still producing the entrepreneurial talent? Are we still producing the ideas?
Absolutely. I mean, we are still producing great ideas. We've still got a lot of talent. There is obviously a flight of, this brain drain that they call it away from the UK. But no, I think universities are still spinning out fantastic projects, whether it's in biosciences and technologies. We've still got great entrepreneurs across energy and security, data security, cyber security. We are actually still very much at the forefront of a lot of the great opportunities of the developed world, I think.
Now, one of the areas that you've been involved with, you're a proud Londoner, you're a big fan of the London market, particularly AIM, the alternative investment market. It's been around a long time.
Yeah.
It strikes me that the number of companies on AIM has really depleted in recent years. Tell us about that depletion, James. Why has it happened?
It's huge. I mean, there's been a deluge of companies leaving AIM. I mean, at the peak in 2007, we had nearly 1,700 companies on AIM. The junior markets were thriving. There was a significant amount of capital available to young companies coming to market, backed predominantly by big pension funds and insurance firms, putting capital to work in the growth areas of the marketplace. And also in the capital markets in general, we had a massive, very highly supportive pension industry that pumped capital into the big blue chips as well. And that has eradicated, that's gone. And over that period, over the last 20 years, AIM has declined significantly. We had a very recent blip in and around COVID, where the number of companies and the funds being raised actually increased a little bit in that period of time. But apart from that, it's been on a steady decline ever since. So we now sit, we had 619 companies on AIM going into the turn of this year.
Down from 1,700, as you said.
1,700.
Huge reduction.
Massive. We now have only 580. We've lost about 40 companies this year, and we've only seen about 6 IPOs. So
now, I know you have specific experience of those. I think you've been involved in a high percentage of the small number of AIM listings that we've had. But just before we get into that, James, and we must, why is AIM so important? Why is the junior tier of the stock market so important? What gap was it filling? Why can't companies get that finance that AIM was previously given to them?
So it's huge, right? It's effectively the lifeblood of the engine room that is the UK economy. So if you think SMEs are responsible in
small and medium-sized enterprises.
Small and medium-sized companies are responsible for about 50% of GDP in the UK, right? It's a significant amount. They employ 60% of the private marketplace, right? So some 16.5 million to 17 million people are employed by small, medium enterprises in the UK. That's a massive amount of tax take for the Treasury and obviously the GDP of the country. And those businesses, in order to survive, they need access to capital. They need to be able to grow. And AIM provided a really rich environment for access to capital and liquidity provision, and also a shopfront window for bigger enterprises to look at companies that they may want to go and acquire, to actually bolt on to grow their businesses. And the two fundamental things that the market provide are paper to do transactions. So if you've got liquidity in your paper and a fair value for that paper.
So you've got traded equity that you can then use to raise money.
Or you can use it to raise money, you can use it to buy other companies, right? Or you can use it to incentivize your staff to stay. You can use it for a number of different things and elements which actually provide real opportunity for those companies. And then the secondary factor is you go out and you raise capital as well against that tradable paper. But what we've seen over the course of the last 20 years is that supportive capital from pension funds is completely gone. But it's gone out of not just small caps, it's gone out of the London markets in general. I mean, at the turn of the century, we had about 40% of pension fund capital was invested in UK equities.
Yeah.
About 70% of their balance sheets was equity capital focused. That's changed immeasurably over that 25-year period, where those pension funds, in order to meet certain requirements from an accounting regulatory perspective, and predominantly because of, I think it was Gordon Brown in 1997 who removed the dividend tax credit from
that
those
ACT change.
Those things have had
1997. Moronic.
Immeasurable.
FRS 17, the regulation you're referring to.
Exactly.
Those two things. So what share of UK pension funds are now in equities? It's more like 5%, right?
It's under 4%.
Yeah.
It's under 4% in UK equities. About 20% of pension funds are now equity focused. Instead, and I'm not a cynic by nature, but, you know, I find it funny that it coincides, the change from equity exposure to government debt exposure for these major pension funds coincides with that period of time where we were borrowing a lot of money in order to pump it into the system.
These pension funds, they've moved into fixed income, right? Which helps the government. They can fund all that government spending, but it takes that massive pool of savings out of equities, out of funding growth, enterprise, jobs.
And jobs, that's exactly it. For the next generation, right, we're not putting that supportive capital to work. Our pension money, right, our savings as a nation do not go into funding our children's and our grandchildren's jobs and the opportunity that those are going to provide. And then obviously the progress through.
They go into funding government spending on welfare and so on.
Those things. So 55% of pension fund capital now sits in government gilts, right? Where it was 75% equity and about 15 to 20% debt exposure.
Yeah.
In order to mirror some of those changes in regulation, and as you said, FRS 17, that major shift has sucked supportive long-term capital out of the market. And what you now find is that the majority of financings and fundraisings are done by smaller, very specific small cap funds that don't have the same strength in capital to deploy, and high net worth and small family office investors. Now their time horizons are much, much shorter. They don't have the same liquidity pool. They don't have the ability to go in and invest for the longer term. They have short-term time horizons and they have less liquidity. They also can't do follow-on financings. I mean, right at the golden era.
All of which AIM can do.
All of which AIM can do and should do.
Because you've got the flexibility as the business owner of having your own paper, as you say, your own equity.
Exactly.
You can build on it. Yeah. You can go back to the market and raise more money.
Yeah, but buy another company or grow or bring in more staff or, And when AIM was really humming along at the turn of this century, or the sort of 2004 to 2008 golden era before the financial crisis, and we'll get into that, because even during the financial crisis, AIM was raising more capital than it does today. But sort of 2004, 5, 6, 7, there were some 9 billion to between 5, 6, 7 to 9 billion raised in new IPO financings on AIM on an annualized basis. That's down to 1 billion, 1.5 billion, 2 in a good year.
Wow.
And some of that's concentrated to one particular investment firm. And that really is quite a stark decline in capital. So you've got very limited IPOs coming to market. And then the secondary market is probably propping up that kind of capital injection to the marketplace, but it's coming from short-term horizons. And what originally happened when those pension funds and big insurance firms were backing smaller companies and your big companies in that space, they would do a lot of the heavy lifting. They'd provide a lot of the early stage capital. Yeah. And then we still had small, specialised small cap funds, and we still had lots of retail and professional investor interest. But they were providing the liquidity support. So they were in the market afterwards, and you had an efficient marketplace where valuations were a lot fairer. I mean, we've got a valuation gap on London equities, and that starts at the top and comes all the way down of about 30 to 50% to other developed
What, a discount?
Marketplaces. Discount. We trade up to
Why is that, James?
Again, it's because of a lack of capital availability and a lack of liquidity, and because most of that pension fund capital, right? So about 20% is now in equity, 4% in UK equities, 16% of that is in international equity, right? And most of that is in the US, right? So a lot of our savings capital is funding foreign businesses,
propping up
the
Magnificent Seven, Nvidia, and
via MSCI
Apple,
World, tracker funds and things like that, and it's not going into to and then that has made listed UK companies a target for international companies to come in and acquire.
Because they're undervalued.
They're massively undervalued.
Because of the lack of liquidity.
Because of lack of liquidity and lack of capital to support them.
So it's a kind of vicious downward spiral that we need to get out of.
It really is, because we're seeing a lack of support for those businesses. And if we had that support, and if we had that capital in the market, and a more efficient marketplace, those valuations would increase in line with their peer comparisons. Everybody would be taken along. I mean, a rising tide lifts all ships, right? So lifts all boats. So you'd end up with ISAs making more money, pensions making more money, and a lot more capital trickling down to the smaller end of the market.
So you talk about a rising tide lifting all boats. Let's specifically get back to AIM, James. I want to come to your specific experiences with AIM. You are an active market participant, a well-known market participant, if I may say so, here in the City of London. What happened with AIM? Why did it go down to the extent that it has? Is it a regulation thing? Is it a fashion thing? Is it external competition?
It's a mixture of those things, not just access to capital and liquidity provisions, as we've gone on about, but then there are significant regulatory hurdles, and there's been a significant amount of impressed regulation on London capital markets, including things like MiFID II, which was implemented in 2018, and these are things that we've sucked in from Europe. Even after leaving Europe, we've still maintained that kind of relationship in the capital markets. So MiFID II, it had an impact on, for example, decoupling research from broking fees. So you now have to actually pay for research if you want to receive it, and that had a detrimental impact on many investment banks. I mean, that research was the lifeblood of a lot of small businesses, because they don't get that much visibility. They're not big, large caps that most people.
So an investment bank would do a little broker's note on a little small company. It could revolutionise
massively.
And the investment bank would do that as a kind of loss leader. Now they have to charge for it. It's a completely different relationship.
Nobody wants to pay for it. What happens? Well, we start to close down the research department. We start to drop out analysts, and that has a negative knock-on effect, because a lot of these smaller businesses, they required that research to be distributed amongst
that third-party endorsement that this is a serious company.
Yeah, exactly that. And then similarly, from a liquidity profile, having some of those pension funds on your balance sheet, on your cap table, that was a third-party endorsement for a lot of kind of investors getting into the marketplace. They'd see an AXA or a Legal & General or a Viva.
They know they've done their due diligence.
And that would be a big help. But ultimately, that's gone away. So there's been regulatory hurdles. There's been the implementation of significant changes in capital provisions in that marketplace. So, for example, we've seen small businesses now on AIM, or they were. It's changing slightly because they've brought in some new rules this year, but they had to have a certain market cap before they would be able to join AIM. And they brought in their own kind of maybe difficult hurdles that smaller companies had to meet in order to actually become public businesses, and that increased cost. So certain additional regulations have increased cost, and that's a burden that small businesses don't really need to bear. So a lot of them, rather than coming to market, AIM used to be relatively fairly priced to list, a couple of £100,000, £300,000 to float on AIM. That would be a sunk cost that the management team would be able to bear. Maybe it's nearly £1 million today.
So professional fees have gone up a lot.
Professional fees have gone up a lot.
But regulatory fees have gone up a lot.
Because of regulatory impact, I think a lot of those advisory fees and things like accountancy fees and legal due diligence fees, and nomads are now charging significant fees to actually police AIM for those companies.
Tell us briefly about your experience of AIM in the last couple of years. I understand you've been involved with a number of listings lately, James, quite a high share of the overall listings. So how many listings have we seen in the last few years, and tell us about your involvement? Yeah,
well, I've been involved with a number of listings, particularly on AIM. This year, my team and I have been involved with, intrinsically involved with 3 of the 6 that have come to market. One of my colleagues is chairman of Serval Resources, which he led the IPO of that very recently. Personally, I've just been involved in the IPO of a company called Talon Resources, which is a gold explorer in Ontario. Financed it and supported the RTO onto AIM, and the team also were heavily responsible for Halo Minerals, which floated at the beginning of the year. So, as a group, we have been intrinsically involved, as I say, in 3 of the 6. At the end of 2024, I actually floated as CEO an AIM AI technology business called Priority Intelligence Group. And I sat on the other side of the fence. I've been an advisor to companies floating on the market for getting on for 20 years. And I had a really, really good, but also difficult experience taking a company to market, where I started to really understand the struggles and the difficulties that companies and directors and management teams find when they are floating their business on AIM. There is a heady amount of corporate regulatory hurdles and environment that you need to jump through, which takes a lot of management time away from really growing the business and really spending time focusing on what matters to delivering the core vision of the company. You're unnecessarily burdened, I think, by a lot of the regulatory hurdles and things that you need to do, and you jump from one audit cycle into another. There's a lot of other things that you need to do, really, and for a small business with a small team that's looking outwardly to grow, that can be a challenge.
A lot of people watching this, James, who aren't finance specialists, who don't know much about AIM, they think, well, why can't a small business just go to a bank and get money? That's the traditional thing. Now, prior to the global financial crisis, bank loans, clearing bank loans, the high street bank loans to SMEs, about 2.5% of GDP, quite chunky. It's now less than 0.5% of GDP.
Yeah.
What's it like as a small business trying to get a loan out of a high street bank?
It's impossible. It's absolutely impossible.
How did that happen?
I think that's a function, obviously, of the financial crisis, post-financial market crash, and again, implementation of regulation. Those major high street banks also had investment arms, so that was decoupled post financial crisis.
So-called ring fencing.
Yeah. So then you now have the investment bank over here and the consumer and customer bank over
the branches are closing. Bank managers don't have relationships with local business leaders.
They don't know them, right? So so where you had the opportunity, and tons of my clients, investors, and entrepreneurs that I know, they talk about times when you would go into the bank, you'd sit down with your bank manager, you'd know you, you'd have a good relationship with you, you'd have borrowed from him before, you'd have been a good customer, and you'd then go in.
Is Basel III an issue here? Sorry to get technical, but you know what I'm talking about. The idea, again, rules from Europe. A bank can't lend on an idea, or you may come, look, I've got this contract to supply these goods, I need finance to create the goods. That's an idea. You can only lend against assets. You can only lend against property, against people's homes, houses, buildings, which immediately discriminates against small firms, right? Is that still an issue?
Yeah, of course it is, yeah, and it still has a big impact on those smaller firms, and because a lot of them, they won't necessarily own property. They'll have service businesses, goods businesses, manufacturing businesses, but there is this kind of fear within the UK marketplace of entrepreneurialism, and risk. Ultimately, the regulator has seemed to want to eradicate risk from capital markets and from the banking industry and the finance industry, and that's impossible, right? It comes with a latent amount of risk. It's required within the system, and if you try to completely eradicate that risk, and we see the same not just in the business and not just with these entrepreneurs looking for loans and lending and also capital from the market, but from individual investors looking to deploy capital into the marketplace. We had a structure where you had to meet 3 specific hurdles on a box ticking exercise to be able to deploy capital into the market, to buy shares, to buy small cap shares. And those were, you either had to be a professional, so somebody who'd been in a regulated capacity for at least 12 months, you had to be a high net worth with at least $500,000 of disposable income, or 2 of the 3 of these, and you had to have done at least 10 trades a quarter in the marketplace. So if you were, a static long-term investor, for example, who deployed millions of pounds into the market and sat on it and watched it grow, you wouldn't meet those two criteria. You know, you could have
been excluded from the market, even though you're a seasoned long-term investor.
Exactly. So a lot of this has come down to, in my opinion, you know, significant overregulation and trying post-financial crisis in 2007 to eradicate risk from the market and to really try and prevent people from losing money. Now, so that's a bad thing. Obviously, we want to make measured investment decisions. We don't want people to lose money. But as a function of a efficient marketplace and a market in general, there's a buyer and a seller, and sometimes one side gets a better deal than the other. And that's ultimately what happens in capital markets. We have to understand that as a fundamental fact.
Just tell us a little bit more about the businesses you're involved with, James, on AIM, the hurdles you've had to overcome. Why is AIM working for those businesses? Do you wish it was 20 years ago when AIM had a bit more liquidity?
So there's a number of companies, not just the business that I floated as CEO, but I've been an advisor to a plethora of companies over the last 10, 15 years specifically on AIM. And a lot of those businesses have suffered with similar issues. The cost of being a public company on AIM, which is an annualized cost, it might cost £1 million to list, but then there's an ongoing annual cost, and that could be £300,000-400,000 a year of corporate governance and fees to advisors. That's negatively impacted and outweighed by their access to capital and the opportunity. And if you've got a business that is significantly undervalued as a listed entity because you have, there's not enough liquidity in the market, there's not enough research in the market, there's not enough support from, long-term capital to really support your true valuation in comparison to your peers and to private equity companies in the same space, then you're going to be looking at why am I even here? Why am I bothering being a listed company? Why am I paying these fees to the exchange? Why am I putting myself through these regulatory hurdles when there are similar companies in the private equity space who are being financed by private equity firms at an ever increasing valuation, and we're not getting that same access to capital, and we're paying out for the privilege of being a regulated business. If that makes sense, being a public company.
So what are the disadvantages then to society as a whole, to investors, to companies, of just going down the private equity route? Is it much more punishing? Do you have to pay a lot more for the finance? Is there less flexibility, less chance for just regular investors to get exposure to these British companies?
Again, a lot of those things. So private equity firms tend to exclude, when they're investing, they'll exclude the kind of ordinary retail or professional investor, the individual. They won't necessarily be able to get access to them in their ISAs and SIPs and things like that. And you've also got, a lot of them dictate where the market's going in terms of, they'll want board seats, they'll want to be intrinsically involved in the management of the company, they'll want quite significant payback terms.
And they want a quick buck, not a long-term,
but they do, but
slow burn investment, right? That's the culture of private equity.
That is the culture of it, but you don't have many exit opportunities now. So there's a saturation in this private equity marketplace because we don't have an efficient market. We don't have an efficient public market. Where do those private companies go when those private equity firms want to exit? Where do they want to sell their stake? Right. Yeah. So they have to either sell it on to another private equity firm, or they're going abroad and looking at marketplaces where there is an efficient market mechanic and the valuation gap doesn't exist. So the US or other global,
the whole company, the whole tax base disappears for the UK, even though the UK's nurtured it, right?
Exactly that. Yeah.
Whereas if it was on AIM, it could get its resources from here. There'd be multiple exits because the shares are listed, right?
Exactly that.
And other local investors could easily buy in. They could just buy the shares.
And they get access to really exciting high growth technology businesses. Things like ARM, for example, that's now gone over to the US, and Darktrace that came off the FTSE 100, and they've been bought up by US private equity. There's examples of really exciting UK technology businesses that no longer live in the UK market.
Who are you calling on here, James? Is it the people that run AIM? Is it the broader City of London? Is it the FCA, our main financial regulator? Is it ministers? Is it the Treasury? Whose ear do you want, and what would you say?
I would say I think there's a cross organisational requirement for significant change to really quell the decline in London capital markets in general. Okay, not just AIM, although I think AIM is a significantly requires that support and help from ministers.
AIM's a flagship, though, isn't it?
It is a flagship, but look.
It's a very British thing. I mean, people around the world know about AIM, right? And now it's diminished.
It's a really exciting small cap junior exchange, and it set the tone for exchanges across Europe and across the world. Yeah. So, but if you look at London capital markets as a whole, okay, and we talked and touched on it in terms of pension fund exposure and other things, the FTSE 350, so the 350 largest listed companies in London on the LSE. I mean, there are some bigger companies even on AIM today than some of those, but the top 350 companies have a combined market cap of about 2.8 trillion pounds. So about $3.5 trillion. Now, $3.5 trillion, the top three companies listed in the US, so Nvidia is 5.1 trillion. The entire FTSE 350 fits into Nvidia.
Yeah.
You've got Google at about 4.3 trillion. The entire FTSE 350 fits into Google. You've got Amazon and Microsoft who are fourth and fifth. And those two are 3 trillion-ish each. Yeah. Microsoft's been up to 4. So the top 5 companies in the US, if you include Apple in that as well, are bigger.
Each of them alone
in a standalone capacity than the FTSE 350 in the UK.
It's unbelievable.
I mean, that's unbelievable. And why is that? Well, if you look at the trend of the two sets of capital markets in the last 20 years, so go back to 2006, the FTSE 100 was sat about 5,000, 5 and a bit thousand. You had the Nasdaq Composite, which was about 2,500, and the Dow Jones about, I think, somewhere around about 11,000 that period of time. So over that period of time, the Dow has shot to 52,000. So about 5 times, about 5-fold it's grown in the size of its businesses, the size of its companies that are listed in the US.
Wow.
The Nasdaq Composite's done even better, obviously led by those Magnificent Seven and the big tech funds, but that's gone from 2,500 to 25,000. So that's 1,000 times bigger.
This is the seedbed of economic growth, isn't it?
Of course it is.
Yeah, the seedbed of tax bases.
And all the people that are employed by these businesses and all of the capital that's deployed.
All the hopes and dreams, all the endeavour.
But also the capital gains tax that's created and everything else that's created by these businesses, an opportunity for really flourishing your economy. The FTSE 100 in comparison, in that same 20-year period, it's gone from 5,000 to 10,000, not 5 and a bit thousand to 10,500, not quite 100% in terms of growth terms. Yeah. And the majority of that has happened in the last 18 months or so. Yeah. So it was stagnant from 2006 to more recently, about 5 to 7,000. It sat in that kind of channel. 8,000 18 months ago, and it's grown about 25% of its entire trajectory in the last 20 years has happened in the last 18 months, with a few core companies having really good years. I mean, Rolls-Royce, for example, has climbed about threefold in that period of time. It's one of the biggest companies on the FTSE now. HSBC's doubled. That is the largest company on the FTSE 100. So some of those individual companies have had good years, but the majority of the market has just been stagnant for 20 years. And that is because of that lack of major supportive long-term capital that has been, pulled out of the market and put into government debt, really.
Penultimate question, your manifesto for AIM, who needs to do what and when?
So I think we need, and I'm harping on about it, but I think we need strong long-term capital back in London's market in general, and I think that will have a really positive trickle-down impact on AIM. Well, I'm not expecting, the reason I'm saying this is because I don't expect pension funds with 50 billion and 100 billion to manage to go in and start putting £5 and £10 million checks into small growth businesses immediately, because they just don't have, it doesn't move the needle for them from an investment landscape. Yeah. But if they were back in and putting capital to work in the large caps to start with, and things like a reversal of that, that dividend tax credit, make it viable for UK pension funds
reverse-
to hold UK equities that pay dividends, right?
So reverse those crazy 1997 rules. Thanks a lot for that, Gordon Brown. You don't even understand the damage that you did.
It's unintended consequences, isn't it? You know,
Presumably get rid of stamp duty on share transactions.
Well, that again, it has that impact, doesn't it? There's 0.5% on transactions in those.
How do we make AIM cheaper? Can we lower the regulatory hurdles on AIM? What are the dangers?
They have started to do some of that. They've started to have an impact on, and they've started to try and make it a little bit easier to bring companies to market on AIM. I'm not sure yet that that's going to have a positive impact on the cost, because they're kind of moving some of the requirements from this ledger to that ledger. For example, they've got rid of the working cap requirement for a company, which was a really significant piece of work. But they now have...
Just explain that, James, sorry.
So the working cap report was a report that your reporting accountant would do. That would give you a clean bill of health for the next 12 to 18 months to make sure you had enough money coming to market that you wouldn't go bust effectively as a small business in the next 18 months and have a lot of, negative press in and around those investors that have come in to support you in a very short period of time. So a working cap report gives a company and the market certainty that at a certain level, and if you manage your capital over the next 18 months in a certain way, that you are fully financed and funded to
run your business. And that convention's
business.
now gone. It's been undermined.
It's not been undermined. They've taken it, but that was somewhere between a 60 and £100,000 piece of work, and would take a significant amount of time for the reporting accountants to put together. They're replacing that with something that is a disclosure-based report. So similar, puts the burden or the onus on the directors and the management team, which I think is fair. But I don't think that's necessarily going to reduce the cost, because I think the reporting accountants are still going to want to charge their fees. I think the Nomad is still going to want to have some clarity on the financial health of the business going forward before they list it. So there's kind of moving things from column A to column B. I think lower the regulatory hurdles for sure. I think try and encourage larger capital back into the marketplace. And where I was going with that is, if we reduce that London valuation gap on our biggest companies, which is 30-40% to our peer comparisons in the US, for argument's sake, what will that do? Well, that will increase the value of those businesses, and by definition, it'll increase the value of people's holdings in those companies, whether it's via ISAs or pensions and SIPs or direct equity exposure. So that will give the man on the street and the investor on the street more money in their pocket. That will mean that those businesses are fairer valued. So they'll be looking around for acquisition targets, use their paper to maybe go and buy a smaller business on AIM, something that's complementary and something that's a good bolt-on for them. What will that do? That will obviously improve the valuations of those companies on AIM, because, that will naturally flex out the kind of value metrics. If somebody's looking at an acquisition of your business, you'll say, okay, well, we're valued here, and that will improve the valuations of the market in general.
How about the Mansion House Declaration, the idea of mandating pension funds to invest in UK companies? I suspect philosophically you wouldn't want to see mandation. You don't strike me as that kind of, so how would you incentivize just that? This is my extra penultimate question.
Yeah.
What would pension funds only get certain tax breaks if they hit certain thresholds for UK equity exposure? And I assume you'd be a strong advocate of including AIM as part of that UK equity exposure.
Absolutely, and also. Growth ISAs, for argument's sake, the opportunity to, we've got a 20 grand investment ISA. If you hold £5,000 in a growth ISA, you get extra taxable incentives. So we want so
you can incentivise individuals as well as institutional investors.
Institutional investors and individuals in a similar fashion by bringing, I think, more opportunity to those from a tax incentive plan. But the Mansion House Accords, look, they have they're pushing for 5% of pension fund capital to go into unlisted equity. I'd like to see listed equity exposure. I think, again, going back to the private equity space, those private firms, as they grow, they need an exit strategy. They need a functioning capital market in London. to be able to give them a chance to float their company and grow again, if that makes sense.
And final question, James Sheehan, if I may. You talk to a lot of international investors. Your life is raising money for British firms, particularly small cap British firms. On AIM, I know you live and breathe the City of London. It's been the passion of your life. How's the UK doing internationally at the moment? What is our politics doing to our international reputation? How hopeful or otherwise are you about this incoming Labour government?
Or the new Labour government, we've had
you can't call it
for a few years.
You can't call it New Labour, can you? But it is a new Labour government. It's not like Tony Blair in '97.
No. That came with the fanfare. Everyone was very excited. I mean, look, it's had a detrimental impact, hasn't it, on the world stage? We can see that. I mean, it's blindingly obvious the way that other major global Western leaders kind of shun our current Prime Minister when he's at functions. It's a sad state of affairs. Ultimately, from a political, ideological perspective, borrow and spend policies and tax the middle classes out of existence policies have had an incredibly detrimental impact on the economy as a whole. And capital markets in general, from my perspective, absolutely. I don't think Andy Burnham is going to change the direction. I think he probably doubles down on a lot of these things. I heard some really worrying reports yesterday of another 38 billion tax grab on the horizon, taking it to over 100 billion in the first 2.5 years of their parliament. That, I mean, is just
massive tax increases.
It's ridiculous. And
Reeves's two budgets basically got us to 70 billion extra taxation, and now you've got another 40 billion coming down the track.
And that's wealth taxes, and that's death taxes, and that's everybody who has done the right things that you would say from a societal perspective, saved their money, put it to work in small businesses or in the economy in general. They're the ones that are finding that they're getting the biggest burden of supporting, what is quite clearly a state that's far too big, huge state, overspending in areas that do not support, the growth of the country or society in general, and, are being wasted.
80% of the money we've borrowed as a government in the last 4 years is on interest payments.
That if we were a business, look.
I mean, how mad is that financially?
Listen, if a business came to me with that balance sheet and said, "Can you float me?" I'd be saying, "No,
you smoking dope.
You're insolvent." So ultimately, that's where we are. If we're spending 80% of the money that we borrow on repaying interest, how long can that?
And last? I know you're a patriotic guy. I mean, I know you love your country. You're still here. Crikey, someone like you could easily go abroad and do your business from anywhere, right? But you are still here. Let's just end on a positive note. What could Britain be? What could AIM be? What could our capital markets be, given that talent that we spoke about at the beginning?
The London capital markets, it has been historically the biggest epicenter, the financial epicenter of the world, right? And I have no doubt, because I've got fantastic colleagues and lots of people that I've worked with over the years, that the skill, the quality, the ingenuity, and the sheer class of that environment has the ability to bring London capital markets back to the very, very top in global markets. I mean, we still do have a fantastic FX market, an insurance market in London, although that's obviously suffering as well. But I think we have the talent. I think we have the capability, the execution capability to be one of the best environments. And what would be really, really good is that we change course. We start to make London capital markets the place that other companies, global companies, want to come and float their business. So rather than everybody talks about and being outward looking and supporting the rest of the world, or how about if we deliver the changes that are required to really turn London's capital markets into the epicenter, the shining beacon that all of those companies want to come and join. So you've got people looking in on us and saying, that's the place that I want to float my business. That's the place that I want to grow my wealth. And that I think would have a really positive impact on the economy as a whole.
How about we do that? Indeed. James Sheehan, thanks a lot for appearing on When the Facts Change.
Thank you very much for having me. Take care.
Thanks for joining When the Facts Change, economics and politics in a fast-moving world with me, Liam Halligan. Please subscribe to my YouTube channel and my podcast via Spotify or the podcast app. And above all, please subscribe to my When the Facts Change Substack.